Ladies and gentlemen, request all of you to please carry your cups of coffee or tea and bring it back to the table. We will be starting with the session right away. May I request our panelists to be brought onto the stage, please. For this session, we have with us Dr. Francisca Onsoj, Chief Economist, South Asia Region, the World Bank Group, USA, Dr. Philips Carlson Zak, Global Chief Economist and Managing Director and Partner, BCG, USA, Dr. Ranil Salgado, IMF Senior Resident Representative for India, Bhutan, IMF, Dr. Ashima Goel, Emeritus Professor, Indira Gandhi Institute of Development Research, and former member of the Monetary Policy Committee of RBI. We have all of them on stage, ladies and gentlemen. I'd like to invite Dr. V. Ananta Nageshwaran, Chief Economic Advisor to the Government of India, to give his opening remarks and chair the session. Over to you, sir.
Okay. Good afternoon, ladies and gentlemen. Thank you very much for being here. I know that towards the fag end of a long day, too much of intellectualism, and therefore you might be looking for some caffeine shots. I hope you can pick up your coffees and teas and come and settle down here. So what we are going to be dealing with in this session is in the post-COVID world, which we're already 4 years into it, the kind of monetary and fiscal policy world that we are entering into. Generally speaking, in the last 35 years, since 1980s, maybe until about 2016 or even 2020, was the era of globalization, steady expansion in global trade, movement of goods, services, and even of people, in some cases of jobs. And that happened to coincide with, or was also an important component of it, was the monetary policy autonomy, monetary policy independence, focus on inflation targeting, liberalized capital flows, and basically it also saw the rise of central bankers as very important policy players. And in fact, the role of governments in terms of fiscal policy was just to make sure that the fiscal policy was generally prudent, keep deficits low, don't overextend yourself, and don't become a pain in some part of the anatomy for monetary policy makers. That was the only role given to elected policy makers. So much so that, the Committee to Save the World was the cover in the year 2000, featured a central banker on the cover, along with the Treasury Secretary and I forget the third person who was there in that Time magazine cover in the year 2000. Of course, shortly after that, the stock market imploded. That's a different story. So, in general, that was the era. So now that this order, this world order, which you heard in the previous session is also, that world order is changing. Whether or not globalization is going to full-scale reversal, we know that it is not going to grow at the same pace at the minimum. If anything, it may go into reverse, and if it goes into reverse, at what speed will it go into is something that we can debate. But along with that, therefore, the primacy and the eminence that monetary policy enjoyed in the last 30 to 40 years, will that also change? Because when it comes to inflation targeting and the success of it, the truth is, post-2008 financial crisis, central bankers tried their very best to reignite inflation with zero interest rates and quantitative easing. They didn't really succeed. And Japan's monetary policy, for example, was a spectacular failure in terms of reigniting inflation, despite decades of zero interest rates and quantitative easing. Then what happened? Post-2020, suddenly, when they didn't want inflation to rise, inflation went to double digits in many countries in Europe and even in the United States, post-2020. And that's partly not because monetary policy succeeded, but fiscal policy also stimulated the economy post-COVID. The economy was dislocated due to supply disruptions, and the combination of all these three factors and the war in Ukraine and the energy prices going up, all these things contributed to reigniting inflation. And we realized, therefore, inflation was not really a monetary phenomena. It required other people to participate to create inflation. More than that. And if anything, therefore, the secular disinflation of the 1990s might very well have been a stroke of luck for central bankers, due to confluence of global trade integration, low energy prices, low commodity prices, but they enjoyed the reputation of inflation slayers. So are all these things going to change now? In spite of the fiscal policy makers being told to remain generally prudent, the truth is, in developed world, public debt has now assumed very large proportions. To the extent that, therefore, interest payments in the United States, for example, now exceed the money spent on defense. Therefore, will central bankers be inevitably dragged into allowing fiscal policy to dominate monetary policy? In other words, whether we like it or not, will financial repression become necessary in the developed world to bring down the real value of debt, as it happened between 1950s and 60s into 70s. The post-World War II debt ratios were brought down in this manner. The second question I want to leave for my panelists is, while there was so much concern in elite circles about not allowing monetary policy to be fiscally dominated, in the process, was monetary policy allowed to be financially dominated by the concerns of asset prices and the financial intermediaries, capital market intermediaries, to be more precise, in the last 30 to 40 years? Will that also undergo a change? For example, notwithstanding the rise in interest rates in the US from 0 to 5.5% between 2022 and 2023, Chicago Fed National Financial Conditions Index remained pretty much in expansionary territory, in loose territory in the last 2 years or so. So therefore, will financial dominance have to give way to fiscal dominance necessarily? Will that be good or bad? And if real value of debt has to be brought down, then what does it do to inflation targeting regimes that we have had so far? Even though it has had accidental success and relatively prominent failures in the last 3 decades. These are my questions for my speakers. Each of them have about 8 minutes or so. Some of them will make standalone remarks. Some of them will make a presentation. I'm going to call them out in the order. You have the speaker bios in front of you, so I'm not going to take up much time reading the speaker bios. We have Dr. Anil Salgado, IMF Senior Resident Representative for India and Bhutan at the International Monetary Fund. He will go first. Second, we have Dr. Francisca Onsorge, Chief Economist for South Asia in the World Bank Group. We have Dr. Philip Carlson Slack, Global Chief Economist, Boston Consulting Group. My apologies if I didn't pronounce his last name correctly. Dr. Ashima Goyal, Emeritus Professor, Indira Gandhi Institute of Development Research, and former member of the Monetary Policy Committee. We have a very distinguished panel with us. So I'll first invite Dr. Ranil Salgado to share his thoughts on the questions and the issues that I posed in my initial remarks. Over to you, Ranil.
Thanks, Ananta. You posed some very good questions, a little broader than I will talk about in my opening remarks, though I will try to hit on at least a couple of them. So my remarks are more focused on developments and policies in the Asia-Pacific region over the past 4 years or so, since we had the COVID-related shocks. So, and focused, of course, on monetary and fiscal policy. So first, let me start with monetary policy and inflation. So we had this surge in inflation in the recovery from COVID, both in terms of intensity and persistence. It started in 2021 and parts of 2022. But you have to remember a lot was going on at that time. We had very accommodative monetary and fiscal policies after the COVID shocks. We had supply constraints and surges in energy and food prices, at least partly reflecting what was happening in Europe with Russia's invasion of Ukraine. Ananta mentioned Japan. I was mission chief on Japan for the IMF until May. And even in Japan, we saw inflation rising to close to 4% and staying above target for over 2 years. And that was from close to 0 to less than 1% inflation for the previous decades. However, in the region as a whole, inflation outcomes have been lower than what we found in other regions. And we also have to acknowledge that the variation was quite wide in the region. And what was interesting is inflation tended to be higher in advanced economies than emerging markets. So how do we explain all this? Well, 2 sets of shocks were important. First, there were some external cost push shocks, especially food prices, which impacted inflation overall. The impact of food price pressures was generally lower in Asian emerging markets than in other regions, despite relatively high weights on food in inflation, headline CPI. And this partly reflected other compositional effects, as well as policy measures, such as subsidies and price controls. The pandemic itself had complex effects. Lockdown set off demand and supply shocks. The supply shocks constrained production, while border closures generated shortages in migrant labor in some of the countries in the region. But overall, demand effects dominated. The lockdowns were generally longer lasting for Asia than elsewhere, and that had some dampening impact on inflation. So how did monetary policy react? So globally, we had this period of quite synchronized monetary policy tightening. And actually, one of the first movers was in the region. It was Korea in August 2021, and also Singapore and New Zealand soon after began to tighten monetary policy. So with falling food and energy prices and restrictive monetary stances, headline inflation in the region generally peaked and started falling towards the end of 2022. That said, financial conditions in advanced countries, except for Japan, financial have tightened as we saw elsewhere. However, in emerging markets, financial conditions remain relatively accommodative. So this meant overall that monetary policy in the Asia-Pacific region, you couldn't follow necessarily a one-size-fits-all model. And the priority of central banks was to ensure that inflation converged to target. At that time, we urged central banks to focus firmly on domestic conditions, avoiding making decisions overly dependent on what was happening with US monetary policy, which could lead to inflation following behind or ahead of the curve and could destabilize inflation expectations. So where are we now? Disinflation has progressed across the region, and most central banks have started to shift to a more accommodative stance. Stepping back, what was observed globally was a quick rise and fall of inflation. The question is, what explains this behavior? On one hand, you could argue that inflation rose because they were subject to varying degrees to a similar sequence of shocks: the pandemic, then mobility restrictions, and then large policy support. On the other hand, one could argue inflation rose everywhere because of global causes, such as higher energy and food prices. Recent research at the IMF showed that the inflation rate trends were primarily linked to global drivers, but local circumstances also mattered. For example, differences in local energy prices, including subsidies for people, price policies, including subsidies for people and businesses, explain differences in the role of energy price shocks in driving inflation. And I think this is true for a number of emerging markets. And monetary policy also played a critical role in defeating inflation. In terms of fiscal policy, the focus at the start of the pandemic was to save lives and livelihoods. So even we at the IMF advised countries to spend heavily, significantly, and they did, swiftly and forcefully. If you add up the total, it was a staggering $12 trillion globally in terms of fiscal stimulus. In the Asia-Pacific region, it acted countercyclically, especially in the advanced country and emerging markets. We found it less so to be true for some of the lower income countries. Also, we saw coordination of fiscal and monetary policies, with 95% of the countries in the region adopting a looser policy mix during the crisis. However, the fiscal costs have been large, and the IMF has written about this, with debt levels much higher. For example, for advanced countries, debt has increased by 14 percentage points of GDP, while in emerging markets, 16% of GDP since 2020. Moving on to the exit from these policies, the exit has not always been smooth. For example, fiscal policies were not reversed fast enough, and this led to pro-cyclical policies. As inflation soared as well, governments faced trade-offs in tackling spikes in food and energy prices when policy buffers were largely exhausted. And some countries use fiscal tools to control inflation, such as subsidies and price controls. An example is fuel subsidies increased substantially for many countries in the region. Monetary and fiscal policy support was paramount, including tightening financial conditions, which and elevated debt, which Anante, I'm running out of time here. Maybe I'll stop there and add the comments later.
Sure, thank you, Ronald. Just one quick question. You may not want to answer it right now. You can probably respond after other speakers have finished speaking. Therefore, the question is: are you basically saying nothing is broken? Is that yeah? You may want to answer now. You can respond later.
Maybe I'll respond
later. Okay. So now I turn the floor over to Francisca. You have your 8 minutes now.
I'll go to a podium because I can't handle 3 things. So for us, the last 5 years gave some wonderful examples of old lessons applied and new lessons learned. So let me go through them a little bit if the presentation comes out here. In 2019, we were worried that the global economy might be an accident waiting to happen. Global debt, at least advanced economy debt, was at record highs, the highest level since the 70s, and even in half of emerging markets, debt was at record highs, the highest on record. At the same time, potential growth had been slowing for a decade already. So potential growth is this long-term sustainable growth. There we go. And when do accidents happen in the global economy? When do financial crises happen? Well, they happen under 3 conditions. When you have high debt, when growth slows a lot, and when US federal funds rates, so US policy rates, peak. And then the pandemic struck. I mean, talk about low growth. So you see in the chart on the left what the pandemic recession did. In the chart on the left, you have what happened to per capita GDP growth, per capita GDP, in each of the last global recessions. 2020 was the deepest output contraction since the Second World War. And yet the global financial system just shrugged. There was no major economy that had a new crisis. There was still some old crisis being worked through. So that's in the chart on the right here, the red line, for you also on the right. Although several of the smaller countries did tip into a crisis, and that includes some of India's neighbors. In advanced economies, output was back to pre-pandemic, not just level, trend. That's the chart in the center here, the red line, already within 2 years. Compare that with 2009, when even 5 years later, the blue line in the center, it was still below the pre-global financial crisis trend. And the reason the impact was relatively short-lived in advanced economies is the lesson they had learned from the global financial crisis, that front-loaded, large fiscal and monetary stimulus can prevent lasting output losses. So basically, they thought this stimulus is what brings us from the blue line to the red line, yeah? Prevents the blue line happening again during the pandemic. And the stimulus was large. On the left side here, you have fiscal stimulus. On the right side, you have monetary stimulus. In advanced economies, the stimulus was large. So for example, the left chart shows you the cumulative fiscal stimulus in red after the global financial, in solid lines after the global financial crisis. No, in solid lines during the pandemic, in dotted lines after the global financial crisis. For advanced economies in blue and for emerging markets in red. You can see that both in advanced economies and in emerging markets, fiscal stimulus was about a percentage point of GDP bigger than in the pandemic than after the global financial crisis. This was a lesson learned from the global financial crisis and applied during the pandemic. Another lesson was on monetary policy. After the global financial crisis, here in the chart on the right, you see monetary policy rates. Monetary policy kind of, at least in advanced economies, but also in emerging markets and developing economies, took a while for interest rates really to be, policy rates to really be cut aggressively. And then gradually they were cut. After the pandemic, they were cut within 2 months to zero. And then they stayed at zero. Policy rates in advanced economies, the blue line here, the blue solid line on the right, stayed at zero for almost 2 years. And that, of course, meant that real policy rates were very low for almost 2 years. Now, emerging markets applied a similar lesson on the fiscal front, but not quite the same lesson on the monetary policy front. So emerging markets and developing economies, here the red lines in the left chart, also provide about a percentage point more stimulus than during the global financial crisis. But on monetary policy, they were much more cautious. Yes, they cut their policy rates, but much less than they did during the global financial crisis. And also they started raising rates, policy rates, already 9 months in. I think Ranil mentioned that. They started policy rates already 9 months into the pandemic because they were worried about inflation pressures. And then this was a lesson learned and applied. Now we come to the new lesson learned during the pandemic. So this extremely accommodative monetary policy globally, of course, then led to very high inflation. And it was kind of a handover from the pandemic supply shocks. We all remember those ships being stuck in harbor. A handover from these pandemic supply shocks then to demand pressures, and then compounded by a commodity price shock after Russia's invasion of Ukraine. And global inflation, you see that here in the left chart, that rose to the highest level since the mid-2000s. Advanced economy inflation actually rose all the way back to 1983 levels. Maybe some of you remember the famous Volcker recession that was caused by an attempt to rein in that advanced economy inflation. And even in emerging markets, and that's the point of the chart in the middle. Remember, emerging markets started tightening policy rates already 9 months into a pandemic, about a year before advanced economies, and still inflation edged up. That's the red line, the red solid line in the center chart here. Still inflation edged up. So that was one of the lessons, the new lessons for emerging markets. And also something that Ananta mentioned, it's hard, it's really hard. It's really hard. Actually, it's something the finance minister this morning mentioned. It's really hard for an emerging market central bank by itself to control its own inflation when around it, everywhere else in the world, inflation is going up. So these inflation spillovers, that is one lesson that emerging markets learned. Advanced economies perhaps learned another lesson, or relearned an old lesson. An extreme amount of monetary accommodation held over a long time, if there's enough shocks will lead to inflation pressures, even in a country that has very well anchored inflation expectations. And then, of course, as soon as that became inevitable, central banks started raising interest rates. You see here in the chart on the right the G7 policy rates. G7 monetary policy rates since the pandemic, since 2022, rose at the steepest and fastest pace since the 1970s. Remember those rates that had triggered the famous Volcker recession in the early 80s. And of course, that then helped bring down inflation, but other things also helped bring down inflation. That's perhaps another lesson, the legacy of good old policies. The global trade system was so flexible that it managed to dissipate these commodity price shocks within 6 to 8 months, 6 to 9 months. So that was one thing that helped. Another thing that helped was decades of building inflation credibility by advanced economies and emerging markets as well. And then also in many countries like India, what helped was the building of, making debt more resilient, maybe more domestically financed. Now the big question will be what the next lesson will be. And perhaps that will not be about how to manage crises, because we've had lots of practice. Maybe that will be how to build growth, sustain growth, which is weighed down, which may be weighed down by industrial policy and trade restrictions. Thank you.
Thank you, Francisca. The screens here have gone blank. Okay, so we have Dr. Philip Carlson to speak next, and I'm just told that in July he published a book with the title "Shocks, Crisis, and False Alarms," and in a pre-session meeting, he told us that the central message of this book is that economics is broken, economic forecasting is broken, and therefore he is the right person, therefore, to address the question of this session. So over to you, Dr. Philip Carlson.
Well, thank you very much. And I don't know if we can bring the slides back up in front of us. Well, and at least you see it on that side. I think that side is blank, but that's good. Let me first say, when we talk about fiscal and monetary policy, what we generally mean is stimulus, the ability to backstop economies when on the brink of crisis, or to accelerate and slow down economies during the cycle. And in my role, I speak with many boardrooms in America and globally, as well as institutional investors, and the question that comes up very often is stimulus at risk? Will we be able or not to backstop the next crisis, and will we be able to juice the economy when we need it and slow it down when not? Now, just as a baselining exercise, the false alarms of the last few years, they're all connected to a misreading of stimulus. Remember the COVID depression? That wasn't. That was because there was a misreading of the amount, the innovation, the willingness and ability of stimulus. It was a fast recovery instead. Similarly, the idea that we're returning to a 1970-style inflation regime was also connected to a misreading of stimulus, which ascribed it only to fiscal policy, which was misguided. Then when we removed stimulus in 22, 23, it was about a supposed cascade of emerging market defaults, which also did not happen. And in the advanced economies, it was about an inevitable recession, the idea that higher interest rates would inevitably lead to a downturn. Now, clearly public discourse, punditry has gotten stimulus wrong repeatedly over the last many years. On the right-hand side, you see the problem with economic forecasting. The dashed lines are economists' consensus. Every single quarter, GDP was forecast as negative, recessionary for the US. In every single quarter, it wasn't. And then this pessimism was simply punted out on the timeline, highlighting the inability to actually forecast this with any degree of precision that would be satisfactory. Now, let me talk a little bit about what I think we need to do to get a better handle on stimulus and its success or failure. And that requires a more eclectic approach, thinking not just about forecast models, but really about history, finance, policy culture, and things like that. And here, in my recently published book, I call this the compulsive stimulus machine, really a 50-year story of how stimulus has evolved in the United States and other countries around the world. Yes, growth in the first panel, it slows down over time. That's sort of a natural course of growing richer and a wealthier economy. And that leads to a political economy pushback, ever more stimulus. So in the 80s in the US, under Reagan, we started with debt. And then leaning against that slowdown over the decades, we became tolerant of bubbles. First of the dot-com bubble, which pushed consumption, which pushed growth. When it collapsed, we moved to a housing bubble where homes became cash machines. When the housing bubble popped, we moved to a bubble in the term premium where long-dated government bonds became bubbly and underpinned a lot of asset classes and their prices. I haven't even mentioned the Fed put. I'll come back to that, and the deficits. But between all these tools, there's a seamless wall of stimulus that reigns the economy. Now, the question is fair. Is it overdone? Have we pushed too hard? Can we do more in the future? Now, let me go into existential stimulus first and then tactical stimulus. Look, I view US existential stimulus capacity as exceptionally strong, despite everything. And not just the US, I think most advanced economies will have the ability to tap into financial markets to finance the next round of stimulus if there is a big crisis. On the left, a reminder that yields fell around the world, not just in the United States when COVID hit. And that really speaks to the enhanced willingness and ability in times of crisis to mobilize resources. That is not just a US thing, but particularly a US thing. Yes, you can land in stimulus failure. History has shown that. It's when policymakers fail to act. That's the 1930s Great Depression. Policymakers standing by, letting the economy bleed out. They're less likely to do that today. Yes, when politicians fail to act, that was TARP in 2008, when US Congress failed to pass a $700 billion stimulus package, but then did do that because it saw the consequences. Or when you have market rejection of funding, which I think is a very, very high bar for the US and most advanced economies. But let's double click on that last point. Is US debt too high? Is there too much debt out there to be comfortable about the future of stimulus? Now, essentially, I view the focus on debt levels as deeply misguided. What we see in the headlines day in, day out is the trillions of dollars of debt or the debt to GDP ratio. Yes, they're very high. Does it tell us a lot about debt and debt risk? It tells us surprisingly little about risk. Why? Because the level of debt is not a good proxy. The question is the sustainability of that debt. And that comes down to what's on the right-hand side here. Nominal growth versus nominal interest rates. When nominal growth is higher than nominal interest rates, we can carry whatever mountain of debt before us without having to set aside real resources. So the question comes down, over the long run, do we believe that US nominal growth is going to be higher than nominal interest rates? Generally, I think so, yes. What you see on the right-hand side conceptually is the diagonal line where they're roughly in equilibrium. If you look at 100 years of R versus G in the US, you see the red dots that populate this picture now. We've been all over this map. But mostly we've been above this line, particularly in the 2010s with lots of financial repression. But even when you're on the line or just below the line, it doesn't mean game over. It just means it becomes harder in terms of the trade-offs we need to make. So existential stimulus, in my mind, is in a good spot. What about tactical stimulus? And I think here is where we really have seen a change come out of COVID. So in the 2010s and before, we had grown accustomed to the Fed put. When there was any worry about the economy, when markets sold off, you immediately had a monetary policy response. In this picture on the y-axis, when the equity market sells off, you immediately see the 2-year yield going to the left, coming down. Why? In anticipation of a Fed put. And that was really the Fed consistently defending the cycle at any sign of worry, really creating a moral hazard problem in financial markets. Now, what you can see in the darker green dots on the right-hand side, in 22, the Fed was not able to defend the cycle. It had to defend the inflation regime. And this is really rates rose even as equity prices came down. And I think this is a lasting consequence, even as inflation has come down. That will stay with us. We're now constrained with tactical stimulus cyclically because essentially of this and my last picture. Yes, inflation is down a lot. So the 1970s narrative was entirely misguided. But note that in the past, to the left, we struggled with the 2% inflation target. Now we're likely to stay above it. So even though inflation isn't very high, the mere fact that it's biased to the upside will constrain monetary policy response. And if they want to do a Fed put, that is now a lot harder thing to do. On the right-hand side, a reminder, the neutral rate of interest at around 3%, who knows exactly where, but let's assume it's around 3%. We're not going below neutral. We're going to stay above neutral. And all of these things will constrain tactical stimulus. With that, I only have one thing left to say. Allow me a quick plug. This and other themes from my recently published book, Shocks, Crises, and False Alarms. Thank you very much.
So we have Dr. Philip Carlson saying basically there is nothing to worry and you can party as hard as you want. Is that the message, Dr. Philip Carlson?
Not on the tactical side. Okay. Tactical side is constrained
so
structurally.
Then we have to have a separate session on tactical, the duration of the tactical horizon and the strategic horizon. Okay, that will be a separate session. We will tell CII to do that later. But now I have the last but not the least at all, Professor Dr. Ashima Goel. She was a member of the Monetary Policy Committee of the Reserve Bank of India. She's a prolific public commentator and professor emeritus at the Indira Gandhi Institute for Development Research. Over to you.
Thank you. And thank you, CII, for the invitation, for bringing so many people together on these important global topics. So I'm going to talk about the emerging market perspective. And basically, as we've all heard, there was a huge fiscal stimulus, basically an overreaction which continues in advanced economies. And this has resulted in monetary policy tightening. Rates remain higher than they were earlier. But it has worked in the sense inflation has come down. The US is scheduled for a soft landing. But there is a cost, which is higher inflation, higher interest rates, higher public debt. And this higher public debt will result in higher interest rates, also volatility in US security yields, which are the safe yields for the world's capital. And emerging markets sees volatility, capital flow surges coming in and out whenever these rates change. So India has faced all this, and the main point I want to make is that for the first time, I think we had the buffers to do it, and we decided to smooth these external shocks. And we use structure strategically to do this, and this has given us one of the highest rates of growth in the world in the post-pandemic years, and inflation that stayed within the tolerance band. And maybe since this is for the global south, there are lessons to learn in this slight differentiation of monetary policy which is possible for emerging markets and can help them. And this answers the question Anand posed for us, that policy is not broken if you do it well. And there is room in many emerging markets to do it well. Yeah? So there is this recovery, but the stimulus in emerging markets was much lower than in advanced economies. And this will result perhaps in volatility in treasury yields going forward. There's no sign of fiscal stimulus, another being reduced. Deficits continue to be at 5 to 7% of GDP for the US. And here also there's a lesson from India in the sense that we are one of the very few countries which is reducing debt and central deficits, with stimulus continuing basically from better quality of spending. So these are the kind of shocks we've had to deal with. This is a picture of oil price shocks. And the other issue is that emerging markets today account for a larger share of global growth, and therefore what the spillovers that affect them create feedback for advanced economies. So there is room for policies that reduce shocks to emerging markets also. So how did India smooth shocks? We've had high average growth rate, about 6% since the liberalizing reforms in the 90s, but this growth was volatile. And so the change in the post-pandemic period was a stable growth for 3 years, about 8%, and there was financial stability as well as falling inflation. So how did this work? First of all, monetary and fiscal policy were counter-cyclical, and one indicator of this was that the real repo rate stayed low, and the real exchange rate also. Normally, in emerging markets, you tend to have very high growths, that nominal growth rate minus the real interest rate, but is high, but it's volatile because policy can't smooth shocks, so there's a lot of fluctuation. This is what happened to India in the last decade. This time we smoothly had R much below G, and this, in a sense, is a kind of it helps enforce this, because this is a positive feedback for the government, since the debt ratios and deficit ratios fall if R is less than G. So we can see this in interest rates that stayed low in the recent period, around 1% real interest rates, and this is a forward-looking real interest rate with the 1-year Treasury bill. For the other issue was that fiscal policy was conservative. After the global financial crisis, there was a jump up in all the deficit ratios, which inched down very, very slowly. This time it was more like a peak, partly because GDP fell so strongly, but after that, all the ratios have been decreasing. So this is also an example of monetary fiscal coordination, and sometimes, because the structure of the economy is such, we saw that the dominant shocks are supply shocks, oil and also food. So in this, fiscal policy can be more effective. And since fiscal policy was working on the supply side, monetary policy could afford to keep real rates somewhat lower. And this was also, as I said, credible. The rewards to the fisc from higher growth helped enforce it. Another enforcement mechanism is that because we had an inflation targeting regime, so the rates, nominal rates, were conditional on inflation. If inflation was going to be persistent and above our bands, then we would raise rates. And this was enough for monetary policy to be credible. Rates did not have to be high, they only had to respond to persistent inflation. So this is also a sort of enforcement mechanism, since policy was conditional on inflation. So we see this, that in WPI inflation, the dotted blue line was really high and volatile in this period, but headline inflation, which is the target, stayed pretty smooth. The fluctuation, the volatility was much lower than in earlier periods. And the other issue is that in emerging markets, the sort of shocks we see with the capital flows tend to increase risk premiums. The interest rate spreads are much higher. And one major contributor to this is the exchange rate volatility. The research shows that the uncovered interest premium is about 3%, which is much higher than actual depreciation. So the other was using multiple instruments, such as the large buffers we had built up, as well as sequenced capital account convertibility, to reduce the volatility of the exchange rate, even while it remained market determined. So this reduced interest rate spreads, the risk premium. Also, macroprudential regulation in the financial markets. We heard this morning about strong bank balance sheets, etc. All this reduced risk premium also in financial markets helped interest rates fall through the spectrum. So in sum, you would say that that it is possible to adapt policy to structure and to the kind of shocks you face as an emerging market. And we've just seen these kind of shocks, supply as well as capital flow surges, risk premium in financial market. So, but very important, while inflation targeting worked, flexibility was very, very important, and balance. Time's up, so I won't go into details, but there are lessons there for how we need to be more nuanced in the way we analyze monetary policies, fiscal policies, and the kind of standards we hold up to emerging markets. Thank you.
I guess one could see that despite being out of the Monetary Policy Committee, Dr. Ashima Goyal held her horses back in the last slide. But anyway, we will continue. We will take up some questions with you. Now that all the four speakers have made their initial remarks, I'll just go back to just posing one question each to all of them and then open the floor for the audience to participate. Otherwise, this will become a typical central bankers kind of meeting, talking among ourselves and the public just being a passive spectator. So we don't want to emulate that. We would make it more participatory. So we will first start with Ranil. So Ranil, basically, is nothing broken and nothing needs to be fixed in the monetary fiscal policy framework, either in the developed world or in emerging markets?
Right. So I'm going to lean towards there are things that don't need to be fixed, but I will then address some things that will need to be fixed. So first of all, if you think back to 2021, and inflation was rising in the US, maybe they were looking back at what happened to the global financial crisis. So they were taking their time before they really ramped up monetary policy. But if you thought that the Fed would raise 75 basis points in 3 consecutive meetings, the concern, at least in Washington, was this would lead to massive crises around the world, massive capital outflows from emerging market economies, and eventually lead to a significant recession in the United States, right, in order to control inflation. What happened? No crises in emerging markets, and the US so far seems to be able to, the Fed has been kind of navigating maybe a potential soft landing. We have to yet see. We don't know if it's a no landing, soft landing, or hard landing, but so far it's been guided. Philip showed the forecast errors. The forecast errors were people were expecting US economy to crash or go into recession much earlier. So something went right. And I attribute that, in emerging markets at least, to improved institutional frameworks. Ashima pointed that out, including in India with flexible inflation targeting, and the fact that emerging markets had already built substantial fiscal and external buffers. That prevented capital outflows. Now, we don't have the full answer yet on whether the Fed has navigated a soft landing, but if it has, it's likely because monetary policy in the United States effectively anchored medium to long-term inflation expectations. Yes, short-term inflation expectations rose along with inflation, but medium to long-term inflation expectations may remain relatively controlled. Now, there were other things going on in the United States as well, right? The United States opened up, including to immigration, that could have helped contain inflation as well as kept growth going. That's not to say everything was perfect. I kind of hinted already that maybe central banks were thinking about the global financial crisis and not taking into account how to think about COVID, which was substantial supply constraints in the context of significant macroeconomic stimulus, both fiscal and monetary. So central banks need to think about how to address a situation like that going forward. Then where things are not as clear that they're not broken, maybe on fiscal policies. So I always feel maybe the long lessons have been drawn from Japan. Because, back in about 2020, a lot of people were talking about this thing called, modern monetary theory, right? Where essentially you could, at least for at minimum advanced countries, but they were thinking even so for emerging markets, you could run endless fiscal stimulus, basically, because Japan ran endless fiscal stimulus. But that was in the context of, if you look at the macro balances in Japan, what you saw is after the collapse of essentially the financial or real estate bubble in the 1990s, first, essentially you had a massive increase in private saving in Japan, right? So if you have a massive increase in private saving, the government was forced to offset that massive increase. So they had to dissave. Also, inflation expectations in Japan effectively fell to zero. So if you have an idea of having some positive inflation, it became very difficult for the Bank of Japan during the period to get inflation up towards a level that they wanted. So I think the long lesson was learned from that. It's not true globally today, especially with the growing demands for fiscal spending, whether it be for climate or for population aging, that you will have a continuing increase in private saving.
Thank you. So I think Ranal spoke like a true technocrat. He put the ball back in the court of the elected representatives to do fiscal policy better. So Francisca, so my question to you is, how do you see the central banks in the developed world react to, because Dr. Philip Carlson also said inflation could still be above the 2% levels. So do you see them resorting to financial repression? Will that become inevitable? Or they can continue with the business as usual?
Thank you for asking this, because we wrote a paper with Carmen Reinhardt on exactly how to resolve high debt, which most countries, the vast majority of countries has now record high debt. And one way of resolving it is financial repression. But financial repression needs to then be combined with capital flow controls, etc. It's not easy to sustain financial repression for sufficiently long to really bring down inflation. Really the best way to really bring down debt. The best way to bring down debt, and it's really a challenge that not just developed countries, that the whole world is facing now, even if Philip was saying we should dismiss it. But assuming we want to address the high debt levels, the best way is to do growth, to generate growth. And there I fear, and this links back to our monetary and fiscal policy discussion, fiscal monetary policy may well have reached their limits in achieving growth. So now it's a challenge for us. How can we generate growth without constantly resorting to fiscal monetary policy?
Okay. So you're basically not answering the question of whether financial repression will be necessary or not. Okay, I take the hint. I go to Dr. Philip Carlson. I think I'm going to take off from the remark made by Ranil about how US 75 basis point interest rate increases in 3 successive meetings was expected to bring the world down. It didn't. And part of the reason could be that the US fiscal policy remained quite expansionary throughout. Even now it does. And secondly, if you look at the way energy costs have evolved pre-COVID and post-COVID, one of the few countries in the world where energy costs have remained relatively unchanged from pre-COVID levels is the United States. Compared to Europe, whether it is domestic users or industrial users, in Europe, the costs have gone up. And maybe the place where higher interest rates in combination with higher energy prices have brought economies down to their knees could be in Europe. So in that sense, what would be, you said, tactically the party can go on for some more time, and you said as long as R is below G, it's fine. But how do you see this monetary policy? You said, right, inflation could be tactically higher, and then this entire narrative around energy transition, raising energy costs for various countries. How do you square all this with your overall upbeat message?
Yeah, so let me maybe circle back to just a few things. So I didn't say debt isn't a problem. I didn't say it's desirable. I said if we want to predict crises, we need to be clear about the debt level as one problem versus growth versus interest rates, which is, I think, a much better guide to assessing risks from debt. In that sense, it really comes down to growth versus interest rates, and if you really want to argue that US nominal interest rates are going to consistently outstrip growth in the United States, then you should be very worried about the public debt level. I don't think it's a great proposition to take or a great argument to make, and therefore I stay pretty relaxed about sort of the big debt risks on US sovereign debt, just for context. Separately, the point about not seeing an emerging market crisis as a result of US monetary policy. I mean, this is one of the headlines I showed. It was such a dominant story. You're going to get a cascade of emerging market defaults. No such thing happened. I would say, echoing a little bit your point earlier, emerging markets got a lot better at doing this. So think about Brazil, think about Mexico. They came out ahead of the Fed. They raised earlier, they raised faster, simply staving off that kind of interest rate differential problem that you historically got. And sort of the memory of the late 1990s Asian financial crisis, I think, weighed on that and really improved monetary policy making. In keeping with one of my themes, let's not always talk down the economy, let's not talk down policy making. There's real progress, there's some real bright spots in how that was played over the last 2-3 years. On the energy side, I mean, for the U.S., it's one issue because essentially we're energy self-sufficient. It can even be an energy exporter, net exporter. So overall, I would think energy is also not as much of a story as it was 10, 20, 30 years ago. You know, the first Gulf War in 1990 put the U.S. economy in a brief recession just because oil prices spiked. That is a much higher bar today. An oil price spike is not going to put the U.S. economy easily into recession. I know that's a story that lingers out there in public discourse, but it's a very high bar for oil to push the U.S. into recession. I will say the Eurozone too. I mean, following Ukraine, that was a universal prediction that not only would the Eurozone see a recession, but an industrial collapse and a deep depression, Germany most of all. Now, clearly they have a lot of headwinds. Germany is in a tough spot, structurally speaking, but there was no Eurozone recession. There wasn't one, right? There were pockets of weakness, but they were able to navigate a brutal energy shock way better than conventional wisdom had it, right? And so I think we need to just step back from extrapolating the data points. We need to have a lot of distance to public discourse. The financial headlines are really written to attract our clicks, our eyeballs. There's a business model behind it of monetizing ad revenue. So I don't think that following these cues from the headlines is a great way of looking at these risks. It's gone better than most predicted.
Okay, so it's gone better than most predicted. Dr. Ashima Goyal, the question to you is therefore, can emerging market central banks afford to sit back and follow their domestic economic imperatives, even if the Federal Reserve next year were not to loosen monetary policy as much as the financial markets are currently expecting? So have we really decoupled? That was one of the themes in the first decade of the millennium, but it proved to be a false start. But this time, is it for real?
I think so, because we've had a lot of pressure after the Ukraine war when there were outflows and reserves were falling. Whenever reserves fall, even in the last 2 months, people get worried, let the rupee go, you lose. But we have enough reserves, and we find that inflows come back. So they are built up again. So we have the reserves, and moreover, because of sequenced capital account convertibility, we are not that interest sensitive. We are more growth sensitive, the inflows that we get. So we are effectively decoupled. But I think because a lot of the analysis and a lot of the inflows also come from the US, analysts are very focused on the US. But there is policy freedom, and I think we used it quite effectively these 3 years. Okay,
so if I'm going to probably do a mini summary before I throw the ball back at the audience court to ask their questions. So we have Ranil telling us that fiscal policy makers have to get their act together. Monetary policy makers are doing fine. And Francisca did not think that financial repression is really needed, but still debt is a challenge. Dr. Philip Carlson wants us not to take a doomsday headlines too seriously. Things are going fine, and Dr. Ashima Goyal thinks that emerging markets have decoupled from developed country policies based on recent evidence. That, of course, begs the question of why Bitcoin is trading at 100,000, or for that matter, gold is heading towards $3,000, and why populations all around the world seem to be somewhat in an angrier mood, replacing governments and worrying about their future growth prospects. And Europe does give the impression of facing an existential political and/or economic crisis. So there seems to be some sort of a disconnect, if I may say so, from the headlines or the real news and the kind of sentiment that we observe around this podium. So with that sort of hanging statement from my side, I'm going to I'm going to invite audience to post their questions. The only thing is, it has to be a question as far as possible. If it is a comment, please don't make a speech. Just make a simple comment. Before I see some hands going up, I want to have some specific people ask their questions. I'm going to start with Mr. Tirthankar Patnaik to ask the first question. He's right here on the right side.
Sir,
please tell us whom you are addressing the question to. Yeah.
my question is to the panel, actually, and it segues from your comments, Dr. Van. I'm uncomfortable at the comfort shown in the panel, frankly. It seems like we've bested growth, inflation, we've bested crisis. We think, I think we know it all in some sense. But are we there yet? We have climate change. We have non-linearities coming up from climate change. We have an increasingly geopolitically active world. You know, the last 30, 40 years were under cooperation that we can't see today. We have also agents reacting far faster to policy earlier. We have this problem of sticky savings, slippery savings, which led to monetary policy not being so effective as needed earlier. And then we have the role of technology as well. Some comfort on this would be very helpful, sir.
So we will wait for a few more questions. I'm going to turn to this side of the hall, and I have Dr. Mr. Michael Every ask a question.
Hear me? Thank you. I don't know who I'm addressing this to, but it's 3 semi-technical questions that I hope would still be understood by the broader audience. Why is it that institutions are still sticking with neoclassical growth models which cannot forecast recessions, so therefore you can never see a crisis coming, when there are economic models out there that can, but you always refuse to use them? Equally, and more simply, why don't you incorporate GDP by supply, when you've had crisis after crisis after crisis recently showing that what is supplied is as, if not more important, than what is demanded? So those 2 simple things, if they were addressed, could go a long way to helping these forecasts and these predictions and these policies make much more sense.
So I saw a hand going up there. Yeah.
It's an extension to discussion, in fact. Definitely there is something which we are missing out on. So, and what I understand, if to bridge between the monetary policy as well as the fiscal policy, maybe should we not include trade credit or the element of trade credit, which is not only about the borrowings, but also about the working capitals which are stuck and all of the issues around. For example, in underdeveloped countries or in developing nations, it is at a very high percentage. For example, in India, it is 80-90%. And also, the connected thing is, are developed nations also affected by this? And still then, why monetary policy is not having any element around this.
Okay, thank you. So I'll now I'll ask the panel to respond to these three questions/observations. So I would request Ranil to respond to the comment/observation, a question posed by Dr. Titankar Patnaik. Yeah.
Right. So I hope I didn't sound too complacent. I didn't mean to. I kind of said I'm going to be a little bit of a defender. Even for monetary policy, there are lessons to be learned, right? In some sense, monetary policy sometimes fights the last for too long. So it has to be more forward-looking, right? So in the context of COVID, the analysis was based probably on the experience of the global financial crisis. And that was clearly not the way to go. So it needs to be a broader spectrum of analysis. So what we're growing focus is not just on the central bank's baseline forecast, but also the potential range of forecasts and risks. So that's an example where monetary policy, I think, has to develop further, especially in advanced countries. That said, I still would be a defender broadly of monetary policy frameworks, especially the progress that has been made in terms of in many emerging markets.
So I would turn to Dr. Philip Carlson to respond to the points made by Mr. Michael Avery.
I'd love to. I very much like the first part of your statement or question, and I disagree with the second part. So yes, we cannot forecast these things, as I showed. The ability to even forecast the next quarter is exceedingly poor. I showed you the consensus forecast success, which is negative. It's a total flop. I disagree with the idea that there's a better model that can do it, which is, I think, what you insinuated. Essentially, the economy is a complex system, and it changes every minute of the day, and that complexity can't easily be conquered, perhaps never. With each new wave of technology, there's new promise that this time we're going to be able to do this much better. I really think we won't be able to do that. And just to give this a little more credence, look at the inflation problem. The Phillips curve completely, utterly flopped, but so did monetarism. Right? Monetarism is still being hammered into the students into the heads of students all around the world, and the Phillips curve is still taught and still will be taught. But on both sides of the spectrum, any model-based forecast really did not serve you well. All of it was situational. All of it was embedded in the political economy. All of it was embedded in history and institutions that history has generated. I call that economic eclecticism. That's one of the themes in the book I mentioned. I generally don't think that we're just sort of inches away from finding the one approach that will allow us to forecast. Economics remains full of uncertainty. For some reason, economists tend to be ashamed of that fact, that they can't forecast. They shouldn't. They should take pride in the fact that it's a complex system, and the best you can do is try to conquer the uncertainty and live with it and be positive about it. That's sort of my view on that.
Can I?
Would you, Dr. Ashima Goel would like to respond to this person asking about the importance of trade credit and, sorry,
Yeah.
you had a follow-up question or remark to make, Michael?
Just very quick response.
Yeah,
I broadly agree, absolutely. The only difference I would add is that within the traditional framework, of course, the assumption is there just won't be a recession. I mean, we know there will be at some point, or the policymakers do, but they do ridiculous things. And I'm talking G7 far more than emerging markets here. But just presume because the models can't show them, their staff will never show them. When they come, they're always a surprise. I'm smelling some Austrianism from what you're saying there, which I fully support and agree. But of course, Austrians do know what to be looking at, which is R and G, et cetera, et cetera. Why isn't that being used by mainstream central banks?
Well, brief response. I mean, look, I think when we look at economic forecasting, I like to distinguish between official forecasts and private forecasts. The private sector gets it wrong all the time, but there's a huge distribution of forecasts. I used to be a sell-side analyst on Wall Street, and I was, publishing forecasts against, dozens of other forecasts. And over time, you see a distribution, you see skews, you see different methods, and every so often you find somebody who you think, well, they got the narrative right, and you go by that North Star. But I think official forecasts are politically constrained. They're not going to predict a recession because, well, you can't do that. So there's limited use to that. Not saying that private forecasts are across the board better, but clearly they're not constrained as much as official forecasts. So there's a lot of complexity in the forecasting world.
I'm going to request both Dr. Ashima Goel and Francisca to respond not only to the last question, but also to the general questions posed by the first three audience members. Yeah.
Yeah.
Please go ahead.
Yeah, so I think your question and Peer's question are pretty similar. That there's so many problems, and you are saying monetary fiscal policy is working fine. The issue is that there have been real shocks we've lived through: pandemic, wars, geopolitical. So people are going to be unhappy. But I think we should also recognize that policies have done better than expected. I agree with Philip that all forecasts have flopped. In India also, people were repeatedly predicting the financial sector is going to collapse because we had NPAs in the last year. Growth is going to collapse, it's going to be negative. And none of that has happened. We've shown the ability to policies to effectively counter shocks. And that is going to help going forward. There are shocks, there are dangers lurking there. But we seem to have some tools to help us deal with them. Then this issue of theory, demand versus supply, I think that you need to generally set conditions for people to for people to respond better, for workers, rather than forecasts in models. And that works much better and takes account of both demand and supply. So related to the credit question, I mean, we found that as conditions were loose in monetary financial conditions, credit growth really grew. We found personal credit loans were growing at 30%. Now, one of the factors that we know is that whenever there's very sharp credit growth, it leads to higher risk and potential NPAs down the road. So what the RBI did was prudential tightening just in that sector. But then it should have been accompanied with a relaxing of the overall monetary tightening, the rate, which was not done. So there was financial, cyclical, fiscal tightening because of the election year, and that is why we're seeing a slowdown currently in the economy. So again, I think that it's a combination of structural supply side factors. We have a lot of room there to improve inflation. I think if the fisc would only focus on long term, developing vegetable supply chains, they would not feel the pressure in the short term to bring food prices down. And then we wouldn't face these repeated inflation shocks. So there's a combination of supply and demand side factors that, you need sort of common sense, I think, more than models. Yeah.
Do you have anything to add to any of those responses, Francisca?
Yeah, just very briefly. So I agree with Ranil that in the last 10, 15 years, we've had plenty of practice with responding to short-term shocks. The problem is the long-term, for two reasons. One is that the mechanisms for responding to these short-term shocks are being increasingly constrained. Once by this debt, that's the demand-side policy being constrained, but also by the structures around us, like, for example, the flexible trade system that dissipated commodity shocks. So that's the one concern about the long term. And the other concern about the long term is exactly what this gentleman mentioned about the supply side. It's how to generate growth on the supply side, not just on the demand side.
So I wanted a couple of more members on the audience to ask questions if they are interested. One is Mr. Kaushik Das from Deutsche Bank and Dr. Dhammakirti Joshi from CRISIL. Very quick questions, please. Mr. Kaushik Das, can someone pass the mic to him, please? Yeah.
Thank you, Anand. I didn't want to ask a complicated question, but President Trump is coming next year, and Scott Bessent, the new year's Treasury Secretary, he wants to bring fiscal deficit down over a period of time in US to 3% while maintaining growth at 3%. Is that possible when President Trump wants to cut taxes as well? So that's the fiscal policy side of the question. And from the monetary policy side, we know that tariffs are coming. Will that be inflationary for the US? In that case, if US interest rates remain at 5%, do you see the risk of growth interest differential being a problem for the US? And to Dr. Goel, the question for EM, if US interest rates stay at 5% for a long time, why should we expect any flows to the EM part of the world, given the interest differential? Because our currency is also going to depreciate. So in that sense, can we expect a lot of depreciation of the currencies in this part of the world?
So you have two questions, one for Dr. Philip Carlson and one for Dr. Ashima Goel. DK?
I think I'll press on the question on forecasting because I think that's an existential question for us also. Now, I think, would it be correct to say that since we don't have control over many parameters that are going to play out, so judgment will have a much greater role in whatever outlook you produce. So it will forecasting will be, in some sense, more a work of art than work of science going ahead. Is that the right way to look at it? And what does it mean for central banks then? Will their policies be also more unpredictable?
So Dr. Philip Carlson can go with both the questions, and then Dr. Ashima Goyal will respond to the question on emerging economies. Yeah.
Yeah, so thank you for those questions on the deficit and on tariffs, right? So in one word, can you achieve 3% deficit with what is stated policy aims? I think no, you cannot. There's nothing wrong with having an ambitious target. There's nothing wrong with that, but even if you just look at the policy agenda pre-election between Harris and Trump, neither of them would have delivered 3% growth. Nobody's willing to score 3%. The CBO isn't willing to score 3%, and that won't happen. It can turn out better than anticipated if you actually manage to rein in spending, or if you manage to cut out cost rather than rein in spending. So, the Department of Government Efficiency, well, let's see what they can deliver. There have been other such commissions in history before. Maybe they will manage to cut out a large amount of cost, but not, in my view, to the level where you'd have a 3% deficit. The other 3% targets, by the way, are realistic. The 3 extra million barrels of oil, I think that's doable. And the 3% growth, in my view, too, is doable. I've been bullish on this economy all through 22, 23, and 24 with a non-recessionary call for the U.S. economy. I have not changed my view on that. I think 2025 will be another outperformance of expectations for the U.S. economy, which is structurally in a very sound spot. On the tariffs, I think essentially we need to be careful when we say inflationary. Do tariffs lead to higher prices? Yes, I believe that. They're going to be passed through to consumers. In that sense, prices will go up. But let's be very careful what inflation is. Inflation is a change concept. It's a sustained change concept. So one-off tariffs are a one-off shock to the price level. If you don't follow up with tariffs the next year and the following period, it does not make inflation, right? It's a one-off shock to the price level. If you're done with it, you're resetting the inflation game. So I think, yes, it's a one-off shock to the price level if they all come at once. It's a shock to consumption, a downward shock or downward push to consumption, and it's also a headwind to growth. But again, if you don't repeat those year after year, they don't become inflation and sustained growth slowdown. In that sense, I conceptually am not super worried about it, and the political economy tells me you will not get those tariffs as advertised. Like the 20% universal plus 60% on China is a possibility, but much more likely is the fact that over the course of the year, this will be watered down in some shape or form, where you land, yes, at higher tariffs, but not to the extent that I think we've seen it articulated on the campaign trail.
Okay, I'm going to probably ask you to respond to DK's question about forecasting being art or science offline, because the organizers have whispered into my ears that I'm overstaying my welcome here on the podium.
Absolutely.
On the stage. So I'll probably ask you to make a quick last response to Kaushik's point. Ashima, you want to, on the emerging markets?
Yeah. Very briefly, we've seen, I was just looking at the data, there's a kind of really V-shaped in FPI inflows to India over the last year and a half. They've always come back after they've gone. Last 2 months, it was a slightly sharper dip, and then they're returning again today. So to say that because US Treasury rates are high, inflows won't come, that's not true. It depends on our growth also. It depends on they want to diversify. And they also tend to react excessively to a rise, but then they rethink and come back. So, yeah.
Thank you. So I think this session has been as much enriched by the knowledge, wisdom, and experience of the panelists on this side of the divide as much as the questions that came from that side of the divide as well. So thank you all very much. One thing that is becoming evident is that as we put behind us the paradigm that prevailed in the last 4 decades and look ahead to a period of uncertainty, I think humans also have to make that leap. When the world is becoming discontinuous, humans usually find themselves lagging a step behind. Even if we agree that all signs point to discontinuity, probably it takes a little bit of time for us to readjust our lens and also what we have been used to. So in that sense, that is itself an important risk factor, which I hope doesn't necessarily play out, and what we witness is incremental change and not discontinuous change, although my instinct tells me that we are in for a period of discontinuous change, and therefore some of the things that may have served as well, arguably, to put it very politely, may not necessarily serve as well going forward, and we need to be a lot more flexible and open-minded to abandon what doesn't work anymore, because economics is about public welfare and not about adherence to a particular ideology that may have evolved due to different compulsions. So with that note, and since we are 6 minutes behind the extra time of 5:50, I'll stop here. I hope you all enjoyed this session. Wish you all a very pleasant evening. Thank you very much for being here.
Can we have a round of applause for this extremely interesting and very, very popular, obviously, session which was going on. Thank you, Dr. Nageshwaran, and all the panelists for the session. May I request Dr. Nageshwaran to kindly hand over a token of appreciation to each of our panelists, please.